Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. You know I am always excited. But one thing that we love to see is accessibility improving for everyday investors.
Absolutely.
And one part of the market that has been less accessible is fixed income.
Yeah.
Just because if you want to buy bonds directly, parcel sizes normally start at like $50,000.
Yeah.
And if you want to access a bond fund, not many of them are listed, so you're dealing with quite high minimums unless you have an advisor and can go through a platform, which leaves people like us out in the cold.
Yep.
Until now.
That's right. Today we are joined by Sam Watkins, Managing Director and Head of Pimco Australia and New Zealand. Now, Pimco are one of the world's largest asset managers, and we are fortunate because they have just launched 4 ETFs that now do give us exposure to this asset class.
Yeah, that's right. So in today's episode, we're going to chat to Sam about Pimco, get him to make the case for fixed income, because I think for a lot of investors, they're probably underweight fixed income. So we'll make him pitch. We'll then talk about the eternal debate, active versus passive investing. Yes, it exists in the fixed income world as well. So we're going to chat about how we should think about that decision. And then we're going to talk about these new range of active ETFs that have come to market that have made this asset class more accessible for Australian investors.
Yes, they've got some pretty bullish assumptions on where rates go over the next 12 months as well.
Now, before we get into it, we want to say a massive thank you to Pimco for sponsoring this episode and helping us keep all of our content here at Equity Mates free and accessible. So with that said, let's get to our conversation with Sam.
Sam, welcome to Equity Mates.
Thank you. Great to be here.
So we want to start with an introduction to Pimco because whilst you'd be pretty familiar amongst the sort of professional finance industry, for many of the Equity Mates audience, they may not have heard of you as much. So can you give us an intro? Who is Pimco?
Yeah, and look, I think that's very true, by the way. Pimco, when we do the barbecue test, as we call it, where you sort of mention where you work, often it's not a name that's known that well to most people. Pimco is a fixed income manager. We're actually the largest active fixed income manager in the world. Our assets under management are approximately $3 trillion.
I'm sure when you say that at the barbecue,
yeah.
people get interested. Yeah.
Sometimes it ends the conversation, honestly. Like, okay. But look, Pimco, it's a firm that actually originates from the US. Our head office is over in Newport Beach, California. And that, of course, is where the firm began it was about 50 years ago now. But we've been in Australia since 1997, so very much, a local footprint and one that's very well known to the institutional and the advised community here.
Now, fixed income for many retail investors won't form a big part of their portfolio, partly due to accessibility for some of the funds and, I guess, bonds themselves, but then also due to the lower rate environment we've been through for the last decade, post GFC, QE, falling rates, fixed interest wasn't really the place a lot of investors were going. But things are changing. So for those new to the asset class, for those thinking about fixed income again in a different rate environment, make the case for fixed income for us.
Sure. So I think, as you rightly mentioned at the start, fixed income hasn't historically been a large part of retail investors' portfolios, whereas in the institutional space, it tends to make up as much as 40%. Now, there's a lot of reasons for that, but I'd start off with the defensive characteristics of fixed income. But the other aspect that I think is really important, and you brought that up around the environment that we find ourselves in, is that interest rates, having gone through the largest increase in the interest rate cycle that we've seen in over 30 years, are now at a level where they represent very attractive returns for end investors. And so, for example, some of the strategies that we're going to discuss later on today have a yield to maturity that is in the sort of 6s and even as high as 7% in some of the strategies. So very attractive returns in an environment that we find ourselves in at the moment, which has a lot of uncertainty, it can represent an attractive alternative to other asset classes.
Just to contextualize that 6 or 7%, like where is that on average, or just sit on average compared to, I guess, the last sort of decade or so?
It's easily the most attractive level of yields that we've seen in over a decade. So that sort of gives you a rough idea of how to contextualize that. And the other thing that I think I'd use to contextualize it is that right now, if you were to look at major bank term deposits, which are often seen as an alternative, somewhere to park your cash while you're waiting to look for perhaps a more racy investment, those are presenting at around about 3.95%. So, with yields in that sort of 5 plus percent for yield to maturity for the strategies that I mentioned, a pretty attractive alternative and one that has a fairly safe and stable outlook that is defensive.
Now, Bryce and I here at Equity Mates are quite big proponents of the core and satellite approach to portfolio construction. So how do you see fixed income fitting in a core and satellite portfolio?
The traditional answer to that question, which would be 60-40, everyone I think might have been familiar with hearing that term of the 60-40 portfolio, that would have 60% of your portfolio in equity or equity-like exposure, 40% in bonds and fixed income for a traditional balanced portfolio. Now, let's take that as being the midpoint. Depending on your age, stage, and your investment objectives, that might range from being as low as perhaps 20% for someone who's very growth focused, and as high as 60 or 70% for someone who is more towards the pension phase where income and stability of assets is important. So very much in the core is how I would describe it.
I read somewhere, and it's like very general, but you can say 110 minus your age is your allocation to equities, and like that like changes over your lifetime then.
Interesting.
Yeah,
Okay.
have you ever heard that before?
I haven't heard that one before. That's
Very
that's
scientific.
A good one.
Feel free to use
Very
it.
scientific.
Scientific.
Yeah, I was trying to
Scientific.
remember it as I was saying it. I think that's
110 minus your age is what you should have to equities.
So, for example, we're 30, so you say 110
30,
minus your age.
Thank you.
Yeah. So you say 80% equities, 20% bonds, but then like our parents who might be, in the, you call it 70, then it's like 110 minus your age. So then they have 40% equity. Yeah.
Do your own research.
Yeah, anyway, something to think about. So, Sam, one of the biggest debates in the equity markets is active versus passive. And you get people lining up on both sides of those debate. And it's become really big in the context of the huge boom in passive index investing over the past 10 years. There is a similar debate in the fixed income world, active versus passive. So give us a sense of the debate, and Pimco as an active manager, give us why you think active makes sense in fixed income.
Look, the first point I'd make is that it's a very worthwhile debate to have. It's a debate that I think shifts through time and depending on what regime that you find yourself in, and certainly is different across asset classes. Beginning where you did, which is with equities, I think you have to look at the data. Look at the historic performance. The data that I would refer to would be Morningstar research that was put out late last year, where it shows that over the last 10 years, approximately 40% of active equity managers have outperformed the benchmark. So you had to be lucky to make sure that you were invested with the right manager and that manager fell within the 40% every year. Looking at fixed income, it's actually the opposite story. 75% of active managers have beaten the benchmark over that same time frame. So you had to be unlucky to choose a manager who was underperforming the benchmark. And I think taking that one step further, what we hold ourselves to is our own, peer group of fixed income active managers. And for Pimco, over the last 5 years, our rolling performance for all of the strategies that we run globally has been that we have beaten 81% of the median active manager. So pretty good statistics, pretty good numbers that suggest that active management in the fixed income space has a strong foundation.
Well, what are some of the, characteristics that retail investors should look for in an active manager when, trying to decide who to back?
When considering an active manager, one of the most important aspects is the size of the firm and the resources that are available. Because for fixed income, the fixed income indices, quite different from equities, are highly complicated. So to put that into perspective, the S&P 500, funnily enough, it does not have 500 shares or stocks that make it up. I believe it's 503. But the Bloomberg Global Bond Index, which is of course the equivalent benchmark, really at a global level, has over 35,000 underlying constituents. And of that 35,000, a large portion of those don't trade regularly. So when you think about how complex that is, how hard it is to make sure that you are managing an exposure that not only matches but exceeds the benchmark, what you require is an organization with a lot of breadth and depth to be able to research those individual names and to be able to transact in those individual names right across the world. So I think size is an important aspect. And then history and performance. I think history and track record is another important ingredient.
Yeah. And I think for people who are newer to the fixed income market, to try and get their head around that complexity, there's like 4 different vectors that they need to understand. It's like the actual issuer themselves, like is it a corporate, is it a government? Then the duration, so is it a short-term bond, is it a long-term bond? If it is long-term, how long does it have left to its maturity? And then there's credit ratings as well, so people probably heard like AAA, AA, B, and then there's also currency, like the bonds denominated in so many different currencies. And so the complexity of that market, even just trying to explain it there, it's tough to get your head around.
I spend my whole life in that space, and it sounds complicated even when you explain it to me there. Look, I think what you've done is paint the picture as to why active management in the space is so important. It is a complicated space. It is very hard to access fixed income as an end investor on a direct basis. So much of what active managers do is not only, of course, have that obligation to chaperone towards the best investments within that space, but also provide access, which is not an easy thing to have.
So let's ground active decisions in the market of the moment, which is full of uncertainty. I think Pimco released a paper recently, "Uncertainty is certain." Seems to be the only thing that we know at the moment. So take us into the investment committee at Pimco, or like take us into the room and talk to us about how your fund managers are approaching this moment with that active hat on and trying to maximize outcomes for their clients.
We have investment forums each quarter, and in each of those quarterly investment forums, the most senior portfolio managers get together and debate the different settings of our portfolios. And we start with the big picture, the macro. So as you rightly say, uncertainty is certain. That's our theme at the moment. And a lot of that is being driven by the policy uncertainty emanating from the US administration. But we also find ourselves at a place where we have a lot of geopolitical uncertainty and we have equity valuations that are close to record highs. We have a lot of moving parts here that make the landscape quite an uncertain one. So the start point for us when we're making decisions around how we construct the portfolios is to try and design a portfolio that is going to perform under a number of different scenarios. So of course we design it with a view to what our base case might look like, but we want to make sure that it's something that is going to be also somewhat, all weather. The other point that I'd make looking at today's landscape, and that uncertainty is a certain element of our current view, is that we have come to the conclusion that looking at the relative yields that are available in fixed income, you don't have to stretch out the risk curve in order to achieve an attractive return. Our strategies, our core view at the moment is to be up in quality, and what that means is to be more at the higher end, at the higher rated end of the investment grade spectrum on average for our portfolios to increase those defensive characteristics.
And so when you say base case, like perhaps using Australia as an example, like what is your base case from a macro point of view?
Yeah, so our base case at the moment is a slowing of growth and sticky inflation. So not a great mix for investors, frankly. And
nice.
that's right. So not a great sort of base case. But I think the one thing that maybe some people can take some solace from is that certainly our base case is not a recession. Although we do see that as being a higher probability than it's been for quite some time. In that environment that is quite uncertain, one where we think that growth is slowing, inflation, we don't think is going to accelerate, but we think is going to remain quite sticky. That's an environment where bonds and fixed income perform very strongly.
And how does that extend to the US?
Very similar sort of viewpoint there, but with a backdrop of course, policy uncertainty, which at the moment I think is making the job of the US Federal Reserve a really tricky one. They, as I'm sure you're aware, have a dual mandate: employment and inflation. And at the moment, what we feel is that where they may have in the past had some level of policy flexibility to be ahead of the curve and cut potentially in anticipation of a weakening of the employment market, because inflation is sticky, it may keep them on the sidelines for longer than they might otherwise be. That said, our view at the moment is that we will see 50 basis points worth of cuts, so 0.5% of cuts from the Federal Reserve throughout this year.
Yeah, right.
I mean, we've got to ask this question. Well, as soon as you start talking about rate cuts, do you have a base case for rate cuts in Australia?
Yeah, of course, it's something we spend a lot of time debating. Our viewpoint on rates in Australia is that we will see 3 more rate cuts this year. So 75 basis points of rate cuts still to come.
So Sam, on your base case for Australia, you said slowing growth, which you would think, okay, well, the RBA needs to loosen policy and cut rates, but then sticky inflation, which might sort of temper that impulse. So how do you think they balance those two parts of your base case? And I guess why does 3 then become the right number?
What we look at is the timing of each of those two things, which is to say, what is the data telling us about the speed of the economy? How fast will that slow down? And how does that play into where rates are set right now? So the starting point. And the starting point for us is a view that we have restrictive settings today, which is to say that if the RBA was to move back to a neutral setting, there would already need to be cuts before you start to take into account what we think is a softening picture of growth. And that's really how we get to the 75 basis points worth of cuts. And the expectation is for that to be represented by 3 25 basis point cuts. And that, as I say, is currently our base case.
God, imagine if they did 3 in 1. Australian housing market would go crazy.
Bang! Oh goodness me!
I think unfortunately, if they would do 3 in 1, it'd be an emergency.
Yeah.
And other things might be going terribly wrong.
Sure.
So let's not hope for that.
No.
Well, Sam, we're going to take a very quick pause here. On the other side, we're going to dig into the range of new active ETFs that Pimco have launched that are giving retail investors access to your strategies. But first, a quick message from you guys.
For over 50 years, Pimco have been at the forefront of fixed income investing, blending deep market expertise with innovative strategies. With their rich history in ETFs, having been one of the first managers to list an active bond ETF in the US back in 2008, they continue to focus on delivering innovative solutions for investors around the world.
Pimco's new ETF range that we'll be unpacking in a moment offers Australian investors access to the same portfolio management teams, the time-tested investment process, and in-house research that have helped it to become an industry leader, delivering strong outcomes for their clients over decades and across every different market environment.
So a massive thank you to Pimco for sponsoring this episode and helping us keep all of our content here at Equity Mates free. And to learn more about Pimco, visit their website, pimco.com/au. All right. Well, Sam, thanks for bearing with us there. And thank you for helping us keep our content free here at Equity Mates. Let's turn to the range of active ETFs. You've launched 4 active fixed income ETFs in Australia, not doing anything in half measures. You love to see. Why was now the right time to launch these?
As I guess you just mentioned, we launched our first active ETF in the US in 2008. And it feels like, I'm sure, and is a very long time between that and launching in Australia. And there's a few reasons behind that and what really drove us to look at now as being the right time to launch the ETFs. The first thing is the rate picture, and the environment that we're in right now being one where fixed income as an asset class is attractive from a return perspective. The second one is that the exchange-traded fund market in Australia really has grown and has accelerated as an asset class. And what we've seen is something in the order of 30% compound growth in that market over the last decade. So really rapid growth. But at the same time, the fixed income asset class is quite underrepresented in terms of the range of options that are available for investors. And so we took the decision that we would look to our flagship funds that have historically only been available to institutions and to advisors, professional advisors, and bring those to the exchange to open them up to a broader range of investors.
It's we love to see it, because I think for years since starting the podcast, we've both felt that getting access to this asset class has been very difficult. So I think that's a good point for us to explore the funds in a bit more detail. Can you take us through the 4 funds that have been launched?
So before we go into detail on each of the funds, I'll list those 4 funds out for you. So the first one is the Pimco Australian Bond Active ETF, which has the ticker of PAUS. The second is the Pimco Global Bond Active ETF that has the exchange ticker of PGBF. We also have the Pimco Diversified Fixed Interest Active ETF that has the exchange ticker of PDFI. And finally, there is our Pimco Global Active ETF that has the ticker of PCRD. Now, if you think about how they fit together and what the key differences are between them, the Australian fund is one that, of course, is made up of Australian fixed income securities. It is very much focused on high quality fixed income. It benchmarks against the Bloomberg Ausbond Composite Index, which of course is what we were talking about when we were describing the active versus passive before. That would be your passive benchmark. And it's a fund that has around about $2.5 billion worth of assets that are currently being managed within it. For the Pimco Global Bond Fund, that is the largest fund that we have in Australia, and it's 8.3 billion of assets under management currently. And the benchmark for that one is the Bloomberg Global Aggregate Index. And that Bloomberg Global Aggregate Index is the one I referred to before that has over 35,000 constituents. Now, that's a fund that is not just a large one in Australia, but is a very substantial portion of the assets that the Pimco run at a global level. The third fund that I mentioned was the Diversified Fixed Income Fund. And what that is actually a 50-50 split between the Australian bond and the global bond fund. And it's a very simple way for people to be able to add a diversified fixed income exposure to their portfolio. The final one, which I'll touch on, is the Global Credit Fund. And the Global Credit Fund, that moves a little bit further out the risk spectrum while still maintaining a high quality investment grade focus, which is to say that there's a little bit less of there is less of the sovereign that makes up that index. And the Global Credit Fund is one that has around about 1.2 billion worth of assets, but maybe to put it in perspective of yields, compared to the Global Bond Index, which has the much higher weighting towards sovereign or government bonds, and that has a yield to maturity of around about 6.3%.
Yeah, I did want to ask a question about the terminology there. So it's useful that you've raised the difference between the Global Bond Fund and the Global Credit Fund, because I was going to ask what's the difference in this case between bonds and credit. So you mentioned there that the credit fund has less government bonds, but is there any other key differences?
The Global Bond Fund, that benchmark has approximately 40% of the total benchmark, which is made up of government bond issuers. For the Global Credit Index, it's the same benchmark without the sovereigns.
Oh, okay.
So it is as simple as that. It's the exact same benchmark, just excluding the sovereign, the government issuers.
Yeah. Okay.
Right.
Yeah. Right.
And so, Sam, for many of the Equity Mates listeners today thinking, just hears more ETFs coming to the market. How do you see people use these 4 funds? Is it choosing just one, or is it a mix of both? How would you, advise us to think about the portfolio construction?
Look, the way in which we would propose is to start with your core question of how much fixed income should you have at a portfolio level. The question as to what part of that should be tilted towards the Australian versus the global bond, that'll often be driven by people's preference for where their performance drivers might come from. So, for example, we have a number of clients that are much more focused on a domestic portfolio. They will hold ASX 200 style equity exposures, and they far prefer to have Australian bonds. And then we have others who are more global in their approach and prefer to have something which is far more diversified, that will instead use either a component of the global bond or perhaps even a total sort of skew towards the global bond allocation. The credit fund that I mentioned before is a move towards a more performance-oriented or performance-focused fixed income. So think about that as being one step, not a large step, but one step out the risk curve within fixed income. And so that is possibly something which is more suitable as being a smaller allocation than a core global bond component or Australian bond component, but one which will add a higher expected return to your fixed income allocation.
Nice.
Now, a lot of these ETFs, the underlying funds have been around for decades. I think we're having a look. The Global Bond Fund inception date was July 1998, so more than 25 years at this point. Give us a sense of their performance to date and how they've gone as unlisted funds.
So for the Global Bond Fund, as you rightly mentioned, it's been around since 1998. And since inception, the performance of the Global Bond Fund has delivered after fees around about 0.5% of performance above the benchmark. And of course, when you're talking about, 26 years, 27 years, 0.5% compounds to a very large number of, amount of outperformance, additional return over time. And looking at a shorter period of time, which is to say how it's performed in the last 1 year, it's delivered net of fees just under 90 basis points or 0.89% of performance above the benchmark. So very strong returns over both the very, very long term and the short term time horizon.
Well, Sam, that brings us to the end of today's episode. We thank you so much for coming in. Congratulations on the launch of the ETFs. We love seeing global fund managers bring their funds to Australia and make them active, make them available for us as retail investors. So we look forward to seeing what else comes. And thanks for coming in today.
Fantastic. Thank you very much for having me.
Thanks, Sam.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.